We're now at the conclusion of our Chapter 1 lecture. We're now going to focus on how to understand cost classification, how it's used in making decisions. We'll focus on what's known as differential costs, sunk costs, and opportunity costs, making sure that we understand what these different terms represent and how they're going to impact our decision-making process. Decisions involve choosing between alternatives. I can either choose option A or I can choose option B. We're going to make decisions based upon identifying those costs that are going to be relevant or irrelevant in our decision-making process. You want to mainly focus on those costs that are relevant, meaning that those costs are going to have an impact on your decision-making process. So we're saying that I could purchase item A or I could purchase item B. And we'll look at what factors are relevant in our decision-making process. In order to make a decision, we must understand three concepts: differential costs, sunk costs, and opportunity costs. If you have a good grasp on these terms, it will assist you in your decision-making process. Differential costs, or what we call incremental costs, are the difference in cost between any two alternatives. And we'll look at that in more detail. There could be a difference in revenue between the two alternatives, which is called differential revenue, or it could be a differential in cost, which is called differential cost. Both are relevant in our decision-making process. So we'll look at again, if I choose option A over option B, is there a difference in revenue involved in that decision? Or if I choose option A over option B, is there a difference in cost pertaining to those two decisions? So we'll look more at the costs here in Chapter 1. The differential cost can either be a fixed cost or it could be a variable cost. Next, we have sunk costs. Sunk costs are costs that have already been incurred and cannot be changed now or in the future. So with sunk costs, we're saying these costs have already taken place. Therefore, they're going to be irrelevant in our decision-making process. They're going to be ignored when making the actual decision. And then you have what's known as opportunity costs. The potential benefit that is given up when one alternative is selected over another. Again, the potential benefit that is given up when one alternative is selected over the other. So we're saying if I choose option A, what benefit am I going to forfeit for choosing option A over option B? So these costs, what we call opportunity costs, are normally not found in the accounting records, but they must be considered in our decision-making process. For example, you all have decided to attend school to get your degree. So what is the opportunity cost you incur by attending class? You may ask yourself, what else could I be doing if I wasn't studying for this accounting class? Now, of course, you made a wise decision by attending this class, but the alternative, whether that would be working a second job or doing something different, that is known as opportunity cost. It is the potential benefit that is given up when you choose one alternative over another. Suppose you're trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the cost of the train ticket relevant in this decision? In other words, should the cost of the train ticket affect the decision of whether you drive or take the train to Portland? Is the train ticket relevant or is it not relevant? What do you say? A or B? B or A? That's correct. Of course, the cost of the train ticket is relevant in your decision making process. You're asking yourself, is it more cost effective to take the train or to drive to Portland? And of course, that will have an impact on the cost of the train ticket compared to the cost of driving to Portland. Okay? Same thing. You're trying to decide again whether to drive or take the train to Portland. You have ample cash to do either, but you don't want to waste money needlessly. Is the annual cost of licensing your car relevant in this decision? So the annual cost you have to pay to license your vehicle, whether it's for the personal property tax, depending on where you live, we're saying, is this going to be relevant in your decision-making process? And the answer is no, because whether you go to Portland or not, you still must pay the annual cost of licensing your vehicle. Therefore, that cost is not relevant in your decision-making process. Suppose that your car could be sold right now for $5,000. Is this a sunk cost? Again, suppose that your car can be sold right now for $5,000 in cash, right now. Is this a sunk cost? And the answer would be no, it is not a sunk cost. And that's because in this situation, because the car can be sold, it is relevant in our decision-making process. I have the opportunity to receive $5,000 right now if I decide to sell my vehicle. Okay? So look at those terms in more details: differential cost, sunk cost, as well as opportunity cost. For our last section, we look in more detail and we prepare what's called an income statement for a merchandising company. We'll look at the traditional format of the income statement and what's called the contribution format. The income statement is a financial statement prepared by a company that shows their revenue and expenses and whether they made a profit or a loss over a specified period of time. On the traditional income statement, used for reporting externally, meaning that it's seen by those outside the company, the normal format is to show sales, which is revenue, less cost of goods sold. So sales shows the amount that we sold the products for. Cost of goods sold shows how much we pay for those products. And the difference is known as our gross margin, sometimes called the gross profit. We then look at those non-manufacturing costs, remember those, selling and admin expenses. Subtract those from our gross margin to determine what's called our net operating income or our profit in the amount of $10,000. Now, internally, we have the same information, but it's shown in a slightly different format. When it comes to our costs, they're broken down by cost behavior, meaning are the costs fixed or the costs variable? So notice the situation, our total cost, like before, total $90,000. It still shows $90,000, but from an internal standpoint, we're more concerned about cost behavior. We separate our variable expenses from our fixed expenses. You'll learn later why that's important, because when it comes time to doing things such as how many units must I sell in order to break even or make a profit, we have to know the difference between our variable costs and our fixed costs to make those type of determinations. So we prepare the income statement internally. We'll use what's called the contribution format, which separate the variable expense from the fixed expenses. The traditional format is sales less cost of goods sold to get your gross margin, less your non-manufacturing expenses to get your net operating income. They both give us the same end result. It's just a different format from the traditional compared to the contribution format. Okay, that will conclude our discussion lecture for Chapter 1. Be sure to review all 3 video lectures. Complete the Chapter 1 Learn Smart assignment. Complete the Chapter 1 homework, and then take your Chapter 1 quiz.